This is Bob Jordan, author of How They Did It, Billion Dollar Insights from the Heart of America. I'm really pleased to be speaking today with George Van Hoegaerden, who runs the venture company. He has perhaps the best blog that is out talking about the venture capital business. George, thanks so much for joining me.
You're welcome. Thanks for having me.
Well, we'd like to dive right into it with you, and if you could just tell us a little bit about your background.
Yeah, so I grew up in the technology space. I've been in technology for about 30 years. Grew up in Europe and moved to the United States about 15, 17 years ago when I was working for Oracle and selling most of their new media products. And Larry Ellison, I couldn't really figure out why I could sell stuff that he couldn't. So I stayed with Oracle for about 2 years at headquarters and then jumped into Silicon Valley, primarily because the opportunities were wide open. Silicon Valley was buzzing and lots of money around, and so I started a few companies, one of which was an early stage company, 4 guys with a business plan, a horrible business plan, I may add, and I told them that. And to my surprise, they came back and said, well, we'd like your opinion on what we should change. And we turned the company into a double-digit Series A and a triple-digit exit in 2006. So I did a few other companies as a result, sat on a bunch of boards, created some other early-stage successes across multitude of companies in the enterprise space, in the new media space, etc. Some other exits associated with that, some of which I can't really talk about because they're private. But I spent the majority of my time as an entrepreneur in Silicon Valley, and my backdrop is that I understand technology very well. So I kind of grew in technology by playing with an HP 41C when I was about 14 years old. And then started programming, and programming turned into an IT manager, et cetera, went into sales and marketing. So I've seen every corner of a technology company, which obviously is very valuable once you start evaluating companies, is very important once you start funding companies as well. So that's my background. I've raised about $14 million of funding for startup companies and obviously produced successful returns. And over that time period, I saw that the risk model of venture was essentially imploding. And as a result of risk imploding, the returns imploded. And I'm surprised that everybody else thinks that there's some other problem with venture, that it's about management fees, et cetera, but we can go into that later.
Well, I'd like to dive right into that because I want to read you something that you wrote. You wrote about innovation is not dead, but that there is a stale venture capital model, what you've called a 40-year-old model that is not compatible with funding and governing disruptive innovation, and that is the real reason why venture, and I'm quoting you, has not and will not produce the returns that it promises. The deployment of risk is fundamentally flawed. It's time to reinvent venture. So with that statement and knowing that a lot of entrepreneurs will be listening to this, what are the best ways to raise money right now?
Well, that depends obviously on what type of company you have. I'd like to step back a little bit to that question and bridge that a little bit. First of all, I think everybody thinks they're an entrepreneur, and the problem is they're not. So entrepreneurialism is really a unique breed. And what do I mean by that? I mean that when you invent something and you expect large returns out of that innovation, you really cannot produce downstream inventions. And downstream meaning that you innovate upon something else that has been innovated by somebody else. This is what is happening in most cases in Silicon Valley, right? We are not producing social economic value. And the reason why we're not is actually that investors don't push the creation of social economic value. So at the end of the day, you have to think to yourself, what innovation am I building? Does that innovation fit the venture capital model? And when you think of venture capital model, you have to produce a 300 million plus return in 5 to 7 years. That's the reality today. So how can you get there, right? And so you have to almost like live in the shoes of the investor that invests in venture capital before you make the decision whether an innovation that you came up with actually fits that model. And I think a lot of the reasons why entrepreneurs do not become successful for a variety of reasons is that they actually pick the wrong investor for the innovation that they're pushing out, right? So the number one issue that an entrepreneur should be honest about is what is the social economic value associated with that innovation, and therefore what is the investor that I need or the set of investors that I need to make that successful.
And in most cases, that answer is not traditional venture capital, right?
Exactly.
Yeah.
Exactly. So, and that's where the disappointments come in, right? Because a lot of entrepreneurs are still pretty savvy and they pitch a good story, but at the end of the day, they get underfunded and cut short in the delivery of some of those objectives. Because most entrepreneurs today, when they go to an investor, the number one thing that they're going to be measured on is milestones. But frankly, if you have large upside that you can promise, I care less about your milestones. Milestones is anticipating how much revenue you're going to make at what point in time. Is that relevant? No, it's relevant that you become the market leader of your space. That's relevant. And whether you have the propensity to do so with all the might and all the money we put behind it. So the question is almost the inverse. Most companies today, when they talk to investors, the only thing they talk about is the protection of downside. Whereas true venture capital is all about the creation of upside. So the fundamental thesis with which you go to a venture capitalist should be, I'm going to own this marketplace, and here's how I project I'm going to do that. Therefore, I need X amount of money. Therefore, you, investor, need to be able to support 80% of that runway to do so. If you can't, you're not the right investor for this innovation. Thank you. Bye-bye. Right? It's very simple. But instead, what we do is we perpetuate, and the media does a good job of that too, is that every innovation gets thrown through this funnel where, we talk about valuations as if innovation is a commodity. Well, if you can talk about an average valuation for an early stage innovation, then you are talking about a commodity. And then you are, by definition, not talking about venture capital. So it's that mismatch of expectations. If you are not the entrepreneur that can build that great innovation that can stand on its own and disrupt a market or create a market or attach to an existing macroeconomic behavior, then you're just not a venture capital company. That doesn't mean that you can't raise money, but you raise money from different sets of investors that are also not primarily venture capital investors, but perhaps private equity investors or micro private equity investors, etc. So the number one reason, and that's why I want to emphasize that, is that a lot of entrepreneurs do not do the diligence on figuring out who they are and who they're going to be, and therefore what type of investor they actually need.
Right. They view the whole process as kind of a black box.
And to no surprise, because it's highly intransparent, right? And that is perhaps the biggest problem with the venture capital business. And let me emphasize what I mean by the venture capital business today. Venture capital is a derivative. And this shocks many venture capitalists I talk to, right? Venture capital doesn't create any value, nor does it have any assets. You have to look at the venture business as a marketplace. And on the left side of that marketplace is a limited partner with an asset called money. The limited partner invests in venture capitalists who then exchange that money for the ideas from entrepreneurs. So the marketplace consists of limited partners with money and entrepreneurs with ideas. And in the middle sits the derivative, the arbitrage, that decides which one is going to be married up with which. Now, the dumbest thing that we can do is assess the performance of venture capital, and say that is an indication of the performance of innovation. Because venture is the derivative to innovation, right? So the key here is that when you go to an investor, that you drive your own proposition that's going to create this fantastic market opportunity, and you do that regardless of the intake criteria of venture capital. Why? Because 35 of 790 investors in the United States actually make any money for their limited partners. And thus, the compass of a VC is not at all indicative of the opportunity of innovation. Venture is a highly incapable arbitrage for innovation. The numbers prove it, right? So the key is when you have an innovation that is worthy, that you drive that innovation and find an investor that understands that proposition, rather than what many entrepreneurs do nowadays is to kind of hone their proposition to what a VC wants to digest. Well, if you realize that most of the VCs are not making money, but they're sitting on a pot of money for 10, 12 years, then you know that you're going to be part of failure and mediocrity rather than become an outlier of innovation by default.
What happens?
Does that make sense?
Oh, yes. I think this is great to hear you talk about this, and I'm curious. I heard a similar comment from Tom Churchwell, an investor in the Midwest, and I'm curious. His take was there might be a dozen firms that are truly successful in the venture world. You take that number of, say, 35 funds out of 750. What happens to the other 715?
Yeah, they'll die, right?
Yeah.
I mean, and that's the reality of it. But the sad part is the following, right? If you realize that the opportunity of technology innovation taps into an 80% greenfield. So now we go back to that marriage of innovation, right, between the assets of a limited partner and the assets of entrepreneurs. If we know that the marketplace, that by the way, in the worst of economic recession, still grew in technology adoption by 7%, right? Mm-hmm. So we're all out of money, but we're still continuing to buy consumer technologies, right? So we have 7% growth in the worst of economic times, and we have an 80% greenfield. Why does the venture capitalist not perform? Right?
Yeah.
So the question you have to ask yourself is that not the potential of innovation is broken, nor the lack of money from limited partners, but simply the arbitrage that picks the wrong innovation. And so if 790 minus whatever the number was, 35 VCs make any money, or the 35 make any money, then the reality is that arbitrage is going to be refreshed. But what it could do is that because arbitrage is defunct and those 700 VCs are going to die off, that will be a severe impediment to the marriages of new types of innovation. And I can tell you that out of those 35 VCs that are still making any money, that doesn't mean that they're actually the right VCs. Some of them just have the brand. And that brand sits around, and they're sitting on a large set of a diversification of money. If my money pool as a VC is big enough, I can always jostle investments around so that some of my funds always look good.
Yeah, while you're not actually being a pure venture investor.
Exactly.
Yeah.
And some of the biggest venture investors are doing this today. So certainly not all of those 35 investors that are supposedly generating performance, and I should also emphasize they are performing and creating a return, not necessarily a venture capital return. We know, for example, that Sequoia makes a lot of money out of pipes. Well, we all think of Sequoia as a venture capital firm, right? So you have to be very careful in assessing where that performance really comes from. And that then goes back to the main question. What actually is the merit of a venture capitalist? Who knows, right? And that is perhaps the biggest problem that we face in venture capital. And I want to emphasize that a little bit. We talk about the United States as being a very free country, perhaps the most free country in the world, most democratic. You hear the rhetoric. But at the end of the day, venture capital is very un-American. Venture capital is not a free market. Okay? And what do I mean by free market? Well, free markets are an economic principle. Free market doesn't mean it's a free-for-all. That's called the Wild West. That's a free-for-all. But free markets are free market principles, which means open access to the supply side, open access to the demand side, an equal and transparent exchange of demand and supply. Now, we don't have that in venture capital today. You do not know when you're an entrepreneur what the actual merit of a general partner is that you're sitting in front of and want money from. That's kind of like dating a girl that you've never seen or heard of before. Yeah. And so you're going to entrust the future of your company over the next 5, 7, 10 years to somebody you know nothing about and doesn't want you to know anything about them. Because they're not, freely giving up that information as to how well they actually did with some of these early stage innovations. Right. So the lack of complete transparency is one example as to why the arbitrage between the assets from a limited partner and the assets from entrepreneurs is the improper marketplace to recognize and govern innovation. You can never find an outlier of innovation if the arbitrage itself is commoditized. Right?
Right. Yeah, and I know
pretty much all investors in Silicon Valley invest the same way. I've seen their private placement memorandums, and they all look and smell the same.
And I know you have a model for limited partners in terms of a different way to look at this, but I want to take you in a different direction here.
Sure.
We interviewed Joel Ronning. He is the founder and CEO of Digital River, a very successful company. And he mentioned something. He talked about the greatest opportunities going forward, and he mentioned one thing, for example, crowdsourcing for new e-commerce platforms. But in general, he said there's 50 years of great opportunity on the internet. My question for you is, where do you see the greatest entrepreneurial opportunities?
Well, where I see it is those entrepreneurs that define innovation correctly. And what do I mean by that? Well, it means that you define innovation that has massive socio-economic value. And it has massive socio-economic value because it attaches to a macroeconomic need. Now, that's a whole mouthful of words, but what it means simply is that you define an innovation that is not hinging on the success of technology to succeed, but is hinging on the market pool to succeed. Take an example. The reason why Apple is successful with iTunes and iPods and all that kind of stuff is because they realize that music is one of the most popular hobbies of people on this planet. And so the only thing you have to do is to realize that the old way of playing music is highly inefficient. You can't take it places, so you can't bring all your music with you, et cetera, et cetera. So the macroeconomic benefit of that innovation, the pool that creates, is overarching the definition of the technology you build. And so it's not the success of the iPod or the success of iTunes or the success of every individual piece of technology. It is what all the combination of all those technologies do to attach to that macroeconomic need, a need that we all have.
What about,
right? So,
go
ahead.
Sorry for interrupting. I'm just curious what your thoughts would be then on, take an example like either Facebook or Groupon. Do those hit those kind of levels of societal need or societal desire?
I think it does, especially Facebook, right? I mean, Facebook essentially ensures that we do what we did hundreds of years ago, which is talk with each other and know about each other, because we're group animals, right? And the fact that we are disenfranchised from each other because we work in these ugly offices and we talk only about work, that's not our social economic need. Our social economic need is to share ideas with each other and as a result feel enriched by the experiences of other people. That's not a need that Facebook defined. That's a need that existed for many years, and Facebook was smart enough to define a technology platform that allows you to do that electronically.
Yeah.
Right? So what we need, to come back to your question, is entrepreneurs who understand those macroeconomic drivers rather than the microeconomic triggers, if you will. Right? And I think those will create massive market penetration, massive valuations. Right? They don't always need a lot of money, but the reality is that capital efficiency is a lie. Most companies that become successful need at least $25 million to get there. So the whole micro VC and angel business is a fantasy. It just doesn't create the returns that make for interesting innovation and therefore interesting acquisitions and therefore interested limited partners. So the more we invest in that stuff, you're investing in technology utilities that never go anywhere. And that's the place we're at right now.
Do you see the U.S. losing its entrepreneurial edge?
Well, I see it declining, and I have seen it decline over the last 15 years or so. But there's good news, right? The bad news is that a business of innovation is in the chokehold of a financial system that is not a free market system, right? And that means that you can have the best innovation, but venture capitalists won't recognize it. You know, how many venture capitalists today actually recognize that you understand macroeconomics and that you therefore have identified a need that is much bigger than just the production of a piece of technology, right? Good luck on that one. So over the years, we've already sort of dumbed down the investment thesis, which means that there's a lot of false negatives, right? Venture capital investors therefore throw money at the same types of companies and then commoditizing set of companies rather than at the outliers of innovation that they should be looking for. So the market model they deploy today is incompatible with finding the outliers of innovation. But the good news is that we have an undying capacity to innovate. Coming from Europe and having traveled the world quite a bit, I realized that the United States still has an unwavering capacity to innovate, and it comes from a cultural heritage from a capitalistic society where if you don't make money, you get afraid, and fear is a great motivator to innovate. And so at the end of the day, even the financial incompatibility of the current system we have on top of venture, there are entrepreneurs that say, yes, but I will still proceed with my dreams, etc. And the benefit the United States has over any country that I've visited is that the culture of innovation is still resident and present. And if I look at other cultures, if you look at, for example, the marketplace that I painted, the limited partners with money, the entrepreneurs with ideas, venture capitalists in the middle, is the arbitrage. Now, most countries don't even have limited partners that actually understand venture capital. Yes, they have limited partners that invest in private equity, but that's a whole different ballgame, right? That's not what creates innovation. That's what grows innovation, has already proven to work. So a lot of other countries in this world, including China, still do not understand that in order for innovation to really work, you have to have limited partners that understand innovation and the unique risk associated with innovation. You have to have a culture of innovation that is not easy to copy. You can't just throw money at an economy and say suddenly all the people in that economy are going to innovate. It's a cultural change that needs to happen. And the only problem we have here in the United States is that we have all those aspects, but we have defunct venture capital. So the minute we change defunct venture capital, we still have the supply of entrepreneurs. We still have supply of limited partners that understand the risk associated with investing in venture, and we can make those marriages happen again. So I see our future as a very positive one. Despite the fact that I'm very critical about venture capital, I'm not critical about the potential to innovate because we have all the ingredients to change the arbitrage, if you will, that sits in the middle that currently chokes it.
George, it's wonderful. George, those are outstanding thoughts. And I've been talking with George Van Hoegaerden of the Venture Company, and I thank you very much.
Yeah, for more information, go visit my website at venturecompany.com.
And your blog is also...
is right on that website.
Is there as well, which is terrific. Great. George, thank you so much.
You're welcome.